what this story is really painting is that the data collection methodologies and the extrapolations, the inferences they make in their calculation in the decline of really good real-time data has made it such that it's not just that the Fed is being stubborn. The fact that they're being so data dependent on real-time data that they know is not in real time and has been continually downgraded as these revisions come make me go like, what are y'all thinking?
As promised, folks, we're going to talk with the one and only Anna Kelly about Fed Day. There's a lot going on. Not only are we going to get an interest rate decision, which according to the betting markets is a lock, more importantly, and perhaps most interestingly, will be Jerome Powell in front of the microphone, because I think he is going to say things like could be starting of a rate cutting cycle or perhaps one and done, right? These are all things that, he could come in and be a dove or a hawk, and it'll be very interesting to see where he goes. But Anna, I think there's a lot going on in the economy.
Yes.
I think most importantly, the job market is not what people made it out to be. It is much worse, and frankly, getting worse, I believe. We also have inflation. Some tariff inflation has come through, some demand destruction inside retail sales with furniture down and things of that nature. What say you? What's Fed Day going to be like? Are they going to do a 0, a quarter, or 50? Where are you sitting today?
Sure, absolutely. Yes to everything you said. I've been warning about the job deterioration for a year and a half at least, and it's very unsettling. You and I've discussed, the thoughts that the numbers are just not accurate. These survey responses are down, and it's making the employment look better than what state level actual data is showing on state level unemployment records and on ADP records. And to see the massive adjustments, 816,000, I think, at the end of 2023 into 2024, another 911,000, I believe, in 2024 to 2025. And so what this story is really painting is that the data collection methodologies and the extrapolations, the inferences they make in their calculation in the decline of really good real-time data has made it such that it's not just that the Fed is being stubborn. The fact that they're being so data dependent on real-time data that they know is not in real time and has been continually downgraded as these revisions come make me go like, what are y'all thinking, right? Because they see more data than what we do, but they've just almost been in denial at how bad the job market has really gotten on a month over month and quarter over quarter basis. And so they've stuck with this, hey, unemployment rates are relatively still low. And while that's true, there's a lot of things that's not in those rates. Can we even believe that unemployment is really, 4.3, 4.4%? I think the data is going to prove out that is not accurate, and it has been higher, and we will see that it will go higher. So, that I think is first and foremost. The last time we had a conversation about Powell and what we thought he would do right before Jackson Hole, although I was saying I think he should be more dovish and he should be paying more attention to the job side, he was going to hold firm to that, big hairy monster of inflation, because they tend to fight the last battle. And his last big mistake was they thought, inflation was transitory, and it wasn't. And we do see some signs that inflation's potentially picking back up, and some history that shows us that initially tariffs become inflationary until the consumer, pulls back and says, we're not going to absorb these costs. Companies have to cut profits. And then eventually they become deflationary. I knew he knew that, but he just was so staunch on, inflation and tariffs and inflation and tariffs, and we're not doing anything till we see where that's going to go, that I was quite frankly shocked, but surprised and happy that he actually was more dovish at Jackson Hole. So I think that was kind of the sounding point where, again, it's what they say, not necessarily what their predictions are as to what they're going to do. And so I would be shocked today, the opposite, if they came back and they're way more hawkish, and Powell in his language says, inflation's so bad that, again, we're not going to have to worry about employment and the rapid changes in unemployment, in layoffs, in the continuous jobless claims, the large and small bankruptcies. We have the largest number of bankruptcies in the first 9 months of the year, 8 months that they've actually counted since 2010 in the great financial crisis. All of those numbers, Michael, will not allow him to be hawkish at this point. They're going to have to realize that we're in a recession. By most measures, right? We're either there or it's the starting of it finally. And they're going to have to be a little more dovish than they have been. So with that said, inflation is ticking up. And so because it is ticking up, and because they know that the initial tariff impact really isn't even in most of those numbers, that's still to come. They know that in the next couple of months, inflation may come back higher. And I think that's going to prevent the quick, massive rate drop that some people are hoping for. Quite frankly, I've said I'd love to see 50 bips, but be careful what you wish for. You know, it can spark more inflation because there's still trillions of dollars on the sidelines waiting for those rates to drop. And
$7.5 trillion in money market accounts.
It's unbelievable. And what happens is the market, the Fed, the market used to be the leading economic indicator. It's still considered one of the 10. It's one of the only 10 that are still in positive territory, despite all of most of the others significantly weakening, as if you go back and listen to our video from last week on the LEIs. But the reality is there is still so much money on the sidelines. And when markets are spooked, bad things happen. And so, you know, the expectation is they've already priced in a 25 basis point cut. They're not, you know, bad news is still good news for them. It's not till bad news is bad news that the markets start to really correct. And then all kinds of things happen, because if the Fed were to come out and say, you know, tomorrow, 50 basis points, that's going to signal to the markets that, oh crap, it's really hit the fan. The Fed is really worried. Recession really is here. And then you start to see a sell-off. And historically, it can easily drop 20, 30% in a couple of days. And so I know Powell doesn't want that to happen, because as people panic and sell out, at the end of irrational exuberance comes like, oh my goodness, like all of a sudden there is a recession, or it might be really bad. And that panic selling really gets into the psyche of you know, people with 401ks, the baby boomers that have the money. The people with money stop spending, and they're the only ones keeping this economy afloat. So with all of that said, my bet is Powell comes out, it's 25 bips, but he signals we're watching and the labor market's deteriorating, and we're expecting to do more cuts by the end of the year. This is the beginning to I think you said the beginning of a rate cutting cycle. I think he's going to signal that. But I think he's going to also try to caution that inflation isn't over. And so we may not be able, we don't know how much we'll cut. It'll depend on what happens on the inflation side. But we do believe that in the longer term, the bigger risk is to the economy and recession and jobs than inflation is, even if it ticks up in the next couple of months. And he'll say we're data dependent. So that's my guess.
Yeah, it's really, you know, I'm glad you brought all that up, because I'm sitting here in two camps. So I'm going to stick with my call of 50 basis points, which I've had for 8 weeks.
Yeah, I'd
before
like
anybody
it,
else.
But I don't think it's going to happen.
Yeah, because to your point, I'm kind of in two camps now. The first camp, why I think 50 is, and it would basically be the Fed admitting July was a mistake. I believe the data since their July meeting, which happened 2 days after their July meeting, has been horrific. And it is my belief, if they had that July data at the Fed meeting, they would have cut. So when I sit here this morning, realizing that the market's only gotten worse, right? The job market, that they almost have to deliver a makeup, right? Sorry, folks, we got July wrong. The data was wrong. You saw the adjustments. We saw the adjustments. You know, June is negative now, right? We had our first negative job creation of 18,000. And oh, by the way, June at the meeting, they thought June was 157,000 to the positive. It's now negative 18,000.
Absolutely.
That is bonkers.
But so, Michael, why didn't they do it when the jobs were revised down 800 and something thousand at the end of 2024?
Well, they did. You know? They did. Well, that was the 50 basis point cut in September. Right?
Is that when the rate adjustments came out?
It was right after that.
Okay. Thank you for refreshing my memory on that.
Yeah, we got the 50, and then we got 2 more quarters, which people thought was election interference.
Right.
But that said, we did get 100. And I think, I really do think, I think 50 is the right answer. However, this is a big old asterisk. you brought up the downside of a 50.
Yeah.
The market is priced in a quarter.
Yes.
The market is not priced in 50.
Mm-mm.
And if the Fed comes out and does 50, if they don't communicate it clearly, two things will happen. One, you're absolutely right. I think the people look at the stock market, realize, it's extremely overvalued by
Yes.
comparison. Earnings go down, multiples go down, 20% off the top inside 30 days.
There's
Bad
no
stuff.
recession priced in. And that's what you have to
Correct.
realize. The PE ratios, the CAPE ratios, they are pricing in, hey, there is no recession. It's
Yep.
soft landing. We're in a recovery. The recession
Milt's
is
up.
over
Yep.
and everything's up. So them coming in and going, oh crap, it totally unwinds their thoughts of, oh, is this PE ratio too high? Do we need to get out before the knife really falls?
Yeah. And the second part of this 50, and this is what we saw last year, the bond vigilantes will go nuts.
100%.
And even though the front end goes lower, we could see the back end go higher, which is not what anybody wants.
Yeah.
And, again, that's why to me, it's very important if they go 50, and I think they should. He has to come out and basically say, folks, we're giving you 50, not because we see bad stuff coming, but because we made a mistake. We should have done the first quarter in July. And this does appear like 50, but realize we're making up for bad data. The data we were given sucked.
The mistake points to we made a mistake in not really realizing how bad the data is coming. So I think the markets would totally read through that and say, yeah, you made a mistake. You can't say nothing bad's coming because your mistake was that bad things have already happened and they probably historically are going to get worse. The other thing that you have to think about, there's just so much money on the sidelines. And most of it has gone into equities where you used to have the 40-60 portfolio, you're kind of balanced between bonds and stocks. And the reason we're kind of in an everything bubble is because everything, money has been cheap. And although rates are restrictive in terms of slowing down borrowing, when you have inflation, it's actually good for equities for a while. And so, if inflation starts to tick down and, labor starts to rise, and unemployment starts to rise and softens, markets are not really, they're kind of discounting the risks of stagflation. And I think if that rears its ugly head, like, oh, there's this real weakening and we have this potential of stagflation and inflation, and then you start having, a lot of money pumped into the system. This is where the bond vigilantes are going to go crazy. A lot of people in the market are also in bonds. Okay. So if they see we're in a recession and they know that it's bad, what comes next? The Fed cuts rates, but also there's usually money printing. And so in order to get you out of a recession, we haven't had one in, 18 years, really quick math in my head, but about 17, 18 years. And so if a lot of this inflation is because of all the money printing, and most inflation is from, easing of the Fed and money printing. I mean, let's face it. It's the threat that there's a repeat, that the Fed and the fiscal heads, Congress do what they always do. They got to start spending more to get us out of it. And what does that do to the debt? It raises the debt. And so they're going to be going, okay, this is bad right now, but it means that there will be more money printing. And it means that the only way the US gets out of all of this debt is they inflate away the dollar. And so then that's why they demand higher treasury yields. Initially, the bond market would go, okay, things are softening, inflation's down. We want a risk premium that's a little, that's basically US treasury plus whatever amount of inflation. If they think inflation is going to be higher, although treasuries have fallen and we've seen a 30-year mortgage rate fall a little bit, it could panic the bond market to go, we're going to demand higher rates on our treasuries. So you've got a stock market kind of, melting down to some extent. And then you've got bond rates going up. So for commercial loans, great. The Fed will keep cutting rates. But what that's going to do to mortgage prices, it could actually raise treasury rates and raise. And so then you've got all kinds of questions as to how do we get out of it? And when you have unconfident, those that lack confidence in both equities and the bond market, because they just have so much uncertainty as to how is the US going to fix this, that's when bad things happen. Will it happen? Who knows? Is there enough stimulation without, can they revalue all their debt and bring, rates down so quickly that we can, reterm out the debt and bring down the interest payments and all of that? It could happen. Could we stimulate growth, to your point, with the big, beautiful bill more quickly to get us out of it and get us into recovery? It could happen, but anything goes. And I think Powell knows that. And I would argue the last thing, because of these complexities and because of the US debt, we are in, some would say yes, some would say no, more of a period of fiscal dominance where monetary fiscal policy has so much more of an impact on the economy. And the tools that the Fed uses may not make that big of a difference. So while everyone's going, oh, we hope they cut 50, right? And I said that last week. The more they cut and the more rapidly they do it, the more rapidly things can potentially start to deteriorate. And the Fed knows that. So I think because they know what usually happens when a big cut comes suddenly, they don't want that scenario. So I think they're going to be very 25 basis points. They're going to keep towing the line. They're going to try to get confidence from the markets and the people so that people could keep spending, markets keep investing, and we avoid the recession that really comes when confidence has gone out the window.
I just had this one final thought on this. And I suspect most people believe that Trump doesn't like Powell and vice versa. Powell doesn't like Trump. I don't think that is a crazy thing to say.
Yeah.
I just had a thought based on everything you've just said. Powell doesn't like Trump. Powell's probably pretty pissed off at him for mucking up the Fed and making his job hard. Powell's out May. Powell knows everything you just said.
Yep,
Maybe he goes, all right, bitch, you want 50? I'll give you 50. And then obviously what happens next? The bond vigilantes revolt, 10-year or mortgage rates go up, not down like Trump wants. And oh, by the way, the stock market loses 20%. And all Powell has to say is, see, I told you.
Yeah.
What do you think?
I hope not. I think
me too, but I'm just wondering.
I hope he cares more about his legacy of trying to fix a problem that happened under his watch. Not that he's to blame, but the Fed and the administration at the time both are culpable for lots and lots of spending that created the inflation that they missed. And I don't think he wants to go out saying, I was too late, Powell, with inflation and too late, Powell, with
that's a bad
recession.
legacy.
And that's a bad legacy, and it's bad for America. So I would hope that he cares about his legacy, but he cares more about America and would try to soften the reality instead of bringing it to full scale, full force, with a bang, that he would try to soften the downside a bit so that it becomes easier to get out of it. And
I would hope so. But
I would hope so.
Part of me is like, all right, here you go. The Fed is acquiesced to your calls for lower rates. Let's do a big 50.
Time will tell. Time will tell.
Yeah.
Tomorrow. We'll know
about
tomorrow,
27
right?
hours. Yeah, 27 hours. All right, folks, let us know in the comments. I will post this evening so we get a full day to watch this. What do you think, folks? Is he going to do 0, a quarter cut, 50 cut? And actually, let's throw a quarter on the upside. Some people are still calling for a Fed raise, but
no way.
No way. Anna, where can people find you?
Great. You can find me here on social media at Anna Kelly, REI Mom. And for real estate and wealth coaching or consulting, you can book an appointment with me at annakellyyinvesting.com.
Thank you.